Hello, I'm Rick Schumacher with LBM Journal, and I'd like to thank you for joining today's webinar, Selling Your Business 101, How to Minimize Taxes and Protect Your Family. Fact: an independent dealer looking to sell their $5 million business may owe $2 million or more in taxes. In today's webinar, Sam Brownell, founder and owner of Stratus Wealth Advisors, will discuss ownership transition options to mitigate taxes, build net worth for the owner's family, and provide continuity for the operations of the business. Sam and his team believe it is never too early to begin building your business for sale, while also preparing your ownership transition strategy for the best after-tax payout. And we'll have live Q&A right after the presentation. So Sam Brownell has lots of letters after his name. We have CVA, CFA, and MBA. I know MBA is Master of Business Administration. What are the other two, Sam?
Yeah, so CVA is Certified Valuation Analyst. It's a designation through a national association that focuses on valuing private businesses.
Okay.
And yeah, valuing them for all kinds, everything from gift and estate tax to merger and acquisition to buy-sell agreements, all the things that a business owner could run into.
Got it. And how about CFA?
So CFA is Chartered Financial Analyst, and that has more to do with the asset management and personal financial planning work we do.
Okay.
That was a designation I actually picked up before I started Stratus. I worked in investment banking, and so that was a big one in the public markets. It's similar to the CVA, but it's for valuing public, your Apples and Googles and people like that, as opposed to your family-owned independent businesses.
Got it. Well, the three are about a perfect combination for what you're doing here for our audience.
Sure. Thank you, Rick. Yep. Nope. That's what I think too.
Okay. So Sam Brownell has been a financial pro since 2006 and formed Stratus Capital Management in July 2013 to provide goals-based financial planning and investment management to individuals, families, and independent business owners. And as the firm grew, an increasing number of independent business owners sought Sam's advice on their short and long-term planning needs, including valuation, tax strategy, business continuity planning, and succession planning. So that's what we're here to talk about today. A couple details before we get started. All attendees are muted, so you can hear us, but we can't hear you. If you're having technical issues, please click the chat button at the bottom of your screen, and we'll address any technical questions in real time. If you have questions for Sam, click the Q&A button at the bottom of your screen, and he'll address as many questions as possible after the presentation. We expect to be finished in about 30 to 40 minutes. We are recording this webinar, and we'll send a link to the recording to everyone who registered. It will also be posted on lbmjournal.com. And today's webinar is sponsored by Stratus Wealth Advisors. You can learn more about the company at stratuswealthadvisors.com, and you can meet Sam in person at the LBM Strategies Conference 2022, which will be held about 3 weeks from now in Denver, October 12th through 14th. And with that, I turn it over to Sam.
Yeah. Thanks, Rick. And thanks to everybody at the LBM Journal team and to everybody listening in today. We realize that oftentimes the subjects of taxes and death aren't terribly exciting, but we'll try to give some examples today and make sure that you walk away with some actionable items and some thoughts that you can bring back to your business and your advisors and your own planning. And we hope to see many of you who are listening today or may download this in the future at the LBM Strategies Conference. It's a great event. So a little plug there for Rick and the team.
Thanks, Sam.
So, yeah, sure. So Stratus Wealth Advisors, we are a full service shop. We focus on independent dealers, do a lot of work in this market. We do everything from valuations for any type of work that you might have. And we'll talk about some of the reasons you might need a valuation today. And then we do succession planning to make sure that we're running that succession plan so that you don't just get a big dump of data and then it's just another thing on your to-do list. So we really want to be there with you to help coordinate this, because for the most part, 99.9% of people will sell their business once. And so we need to make sure that we really think this through and do it right, because it can be a great way to build multi-generational wealth in your family. And then we also do provide asset management and personal financial planning but we're happy to coordinate with folks, individual planners and brokers, et cetera, if you have them. So we're very flexible in how we work. So just to get started, I figured this cartoon probably a good way to get going. And as many of you are well aware, taxes, right? Taxes can be a really important planning item, because otherwise you're going to end up owing a lot more money than you want. And so we'll talk about it a couple times today, but it's net after tax, what you get from the business. That's what really matters. And so strategizing as to how best to do this, because the tax and the estate piece, excuse me, also have to fit in with the continuity of your operations, making sure you're training future leaders, making sure that you're providing employment opportunities in your community, you're giving back, all of the things that you do really well. We want to make sure that those also can continue to run while we're all thinking about some of these more technical items. So just kind of a life cycle idea here of the way that succession planning works. You know, business valuation is really important, and we start almost every single succession planning engagement with evaluation, because we need to know where you stand, right? What's the business worth today? Can that fund your post-ownership goals? Can that maintain your standard of living? Or are there things that we need to do to maximize that net worth? And then we need to look at transition options, and we'll talk about a number of them today. And from our perspective, it's really important that everybody knows we are completely agnostic. We don't care how the business transitions. What we want to do is listen to your goals, think about the different options out there, and try to figure out what is the right option given the parameters that are your situation. So, and that gets into the more technical details of tax and estate planning that we'll get into today. So we're going to first spend some time on tax mitigation. And there are really three different ways that we plan for this. One is what happens pre-sale. What can we do leading up to the sale to help mitigate those taxes? Then how do we structure the sale? And we'll talk about some of the different structures that are out there. And then how are you going to get paid? Because all of these make a difference to, as we say at the bottom, that net. What are you getting net from the business? And how does that ultimately impact your family, that intergenerational wealth? So let's think about a couple pre-sales. So what can we do in the years leading up to? And the first one is to really have a conversation. And this can be with somebody like us. This can be with a spouse, a trusted advisor, maybe a mentor in the industry, of what do you think would be the best buyer? Is it internal? Is it external? And we've seen a ton of M&A activity recently, and that's great. And there are some really good buyers out there, strategic buyers, financial buyers, but that tends to come and go, right, with the economic cycles. And so good businesses always sell. It's just a question of how you sell them and who you sell them to. And so it's really important to think through things like, okay, what are the tax brackets of everybody involved? So for example, if you are the owner and you are in the 37% tax bracket and you have some employees who would like to buy the business and they're in the 24% tax bracket, well, can you bump up their salary a little bit so that they can start buying out some ownership slowly over time so that you can feel out, well, are these people actually good ownership candidate materials before you turn over complete majority control of the company? And it means that they're doing it at a lower tax rate than might otherwise happen if you, the owner, were just getting a chunk of change, $5 million, let's say, on the closing date of the sale. So that's important. Another one we look at a lot in the internal transfers are either gifting or granting. And so the difference really is gifts are family members. Grants are to those key employees. But it accomplishes the same thing in terms of, if we determine that you don't need your full sale value to fund your post-ownership lifestyle, so that business value plus your retirement accounts plus your real estate cash on hand, etc. That's going to be great for you and your spouse to live off of. Or maybe we can gift some of the business, and that provides an opportunity for some tax breaks, and we'll talk about that a little bit. And then another thing I wanted to touch on, and we'll get to it later too, is employee ownership, right? ESOPs, employee stock ownership plans, even things like worker-owned cooperatives. They are a very tax advantageous way to transition ownership of your business to your workers while still getting paid that full market value for your business. And so there are some common myths about employee ownership that we'll talk about a little bit later, because if it's the right fit for your company, it can be a huge tax benefit to the owner, especially for folks who are in C corporations. And so that's kind of a starting place, is we need to figure out how your entity is structured, because the way that your entity is structured impacts the way that we will plan to mitigate taxes. So let's get a little bit more. This is a scenario for an internal transfer. And so, for example, if your business is worth $5 million and we run that retirement post cash flow analysis, and we figure out that you're only going to need about 3.5 plus your other assets to really live comfortably, then there's an opportunity to provide a slow transition of ownership over time by, let's say, gifting 10% a year. And so maybe we're going to gift $500,000 or so each year to a child or children, or we're going to grant to those key employees. And so what that does is it shifts the tax burden off of the owner, and it allows you to provide ownership to another internal person to really test whether or not this is going to work. Because as anybody who's listening here who is an owner knows, being an owner is much different than even being a management executive level employee. Right? There's just an additional level of commitment that you need as an owner. And so sometimes doing a slower transition can allow those internal folks the time to develop into this role, as opposed to just having it thrust on them at the end of the day. And so typically what we see in these strategies is we'll do a 3-year gifting or granting, and then at the end of that 3rd year, if everything looks good, there'll be some type of note that's signed, whether it's financed by you as the owner and the cash flow of the business, or the buyer or buyers go and get a note from a bank. That then will be the rest of the payout. So 10% for 3 years and then 70% after that. And so it really is about, how do we shift the tax burden around here to provide the best after tax for everybody involved. And so this is just one of many different ways that we look at this. And it's very situation specific. And then that's why it's really important for us to get to know our clients very, very well. So structure of the sale. So once we get to the structure of the sale, they're kind of the two major ones: asset sales and stock sales. Asset sales, typically M&A, right? I'm selling my business to a strategic or financial acquirer. Stock sales typically are internal. I'm selling my company to my kids, I'm selling it to my employees. And we'll talk about the differences between the two. And we'll also talk about the second bullet here, which is purchase price allocation and why that's important. And then we'll get to stuff about employee ownership. So a stock sale, that is, I run a C S corp. It can be an LLC too, right? But in an LLC, they're called units as opposed to stock. Well, let's say I own a C or an S corp, right? And I want to sell that stock. That's a great way to do it, because typically it's going to be capital gains, which for most people is going to be a lower rate than ordinary income. C corporations can avoid that corporate level tax, right? So they only get taxed once. Liabilities, though, will shift from the seller to the buyer. And this is one of the reasons that typically strategic and financial buyers don't like a stock sale, because they don't want to take on your liabilities. But if I'm selling my business to Rick and I know that he's going to continue the business, I don't want him to have to go out and create a new LLC or C corporation to then absorb the assets of my business and then it's a lot more work than just him buying the stock, taking on the name of Stratus Wealth Advisors. It's got a great name in the community. We want to continue that. So I think there are times to use this. And then it's also easier to assign contracts and leases in a stock sale, right? Because the business will continue over time. One of the downsides, though, is going to be there's no step up in basis, right? With an asset sale, we'll talk about on the next slide, you can step up the basis of depreciable assets, which becomes very useful to the buyer. And so, it's all based off of what you want to do, what are the parameters of your situation, and just trying to think through what would work best. Because if we try to optimize one variable, it impacts another one. So there's a lot going on here, but it really is about making sure that the business is sustainable in a stock sale over time. And so the asset sale is a little bit different, right? As it says, you're buying the assets. And so typically there may be a mix of ordinary income and capital gains rates. C corporations are going to pay at the corporate level, and then they're going to pay again when those distributions get made to the shareholders. Now, one of the benefits of a C corporation, if you could call it that, is if I sell my assets to Rick, I can keep my C corporation open. I'll pay corporate level taxes, but I'm not going to pay individual level taxes until I make distributions to myself. So if I keep that C corporation open for 10 years, I can potentially spread out how I'm getting paid over time, so I don't have to take the huge chunk right in year one. And part of that's going to depend on the state you're in. What are the rules for keeping a C corporation in good standing and all of that. But again, like I said, liabilities stay with the seller. So this is a very popular option if you're selling to a strategic or a financial buyer. And then there's this thing about step up in basis. And so purchase price allocation becomes important here. If I'm selling my business, what I want is to allocate as much of the price as possible to assets like land or goodwill that are going to be taxed at long-term capital gains rates. Rick, as the buyer, wants the exact opposite. He wants to put as much of the purchase price as possible in areas like receivables, inventory, fixed assets, things that he can either depreciate very quickly or things that he can expense and lower taxable income. And so this becomes an important discussion and negotiation point in an asset sale is what is the right purchase price allocation? What's the right balance for buyer and seller? Because both the buyer and the seller have to report the exact same purchase price to the IRS. And so the last thing you want to do is have them reporting different things, because that raises huge red flags. And audits are always a bad thing. So let's talk a little bit about sale to your employees. One of the benefits of selling to your employees is they know your business. You're having people take over the business that really know what you're doing. Right? From a tax standpoint, you can use pre-tax dollars to buy out the current owner. That's great, lowers your taxable income. Benefit to the owner is they can receive fair market value. You're not having to take a haircut, so to speak, on the purchase price because you decided to sell to an employee stock ownership plan. You can get a very, very fair price that you would get in the market. So it's not like you're having to say, well, I'll take 80% of what I could get because it just makes me feel good to sell to my workers. Nope, that's not the way that these things are structured. And then depending on your entity structure, cash flow needs, et cetera, there may be opportunities to defer taxes indefinitely for the selling owner. And depending on the setup of the entity itself, the entity may be able to operate going forward without paying taxable income. And so, these can be really, really powerful tools if it's the right fit for you. All right. And now, as always, the downsides, right? Putting something like this together requires professionals. It's going to cost money. I mean, most ESOPs are going to cost probably $40,000 to $50,000 on the low end, because you're going to need valuation specialists. You're going to need lawyers, accountants, all this stuff to put it together. But once it gets running, the long-term benefits can be huge. So these are things that we look for. You know, the business has got to have good cash flow because you want to be able to continue operating while paying out an owner, right? And you need to have a good management team. If you're selling to your employees, one of the biggest concerns we hear from folks is, well, geez, I love the guy that drives the forklifts in the yard, but he can't run my business. And the response is, don't worry. You're selling to your employees doesn't mean that the guy you just hired to drive the forklift or the person who's been working at the truss plant is going to be in charge of management, right? There is still a management team, and many ESOPs and other plans, you know, a worker-owned cooperative they hire outside CEOs to run the business, or they keep their management team intact. And so one of the keys to employee ownership is really dividing out what is the employee job as an owner versus what can management do. And you want to have a wide berth there. You know, you want to just have large decisions such as, should we sell the business? Do we admit a new member? Do we merge with another company? Those should be things that get taken to the broader employees. Whereas on the flip side, talking about things like, should we invest in a new truck? Like, those are management decisions. That has nothing to do with the overall voting of the membership of all of the employees. So it's a really important distinction to make. So let's touch here on post-sale. So we've set up what we want to do pre-sale. We've structured a sale that works to try to mitigate taxes. And now we got to think about the payout, right? And again, depending on who you sell to, is it lump sum or is it payout over time? And John Wagner did a great M&A Basics 101 a couple of weeks ago, but more and more, even in an M&A transaction, you're seeing less cash up front and more of payouts over time. And so you just need to be aware of how these impact your tax liability and what you're paying. Are you paying capital gains rates? Are you paying ordinary income rates? And this really matters because you could be paying 15, at most 23.8% at the federal level for your long-term capital gains, but up to 37% for ordinary income. So it really matters when you start thinking about the sale. You know, if I'm going to take a lump sum and I'm not a C corporation, right, and everything's going to be passed through to me, what does that mean? What is my tax bracket? Is everything going to be taxed at ordinary income? Is everything going to be taxed at capital gains? And I'll give you an example. Say that you're a C corporation. You bought the company from your parents 30, 35 years ago for $1 million. Company's now worth $5 or $6 million. That's a sizable gain, right? That's $4 or $5 million of taxable gain there. So we're going to have to think through, how do we set this up so that you don't end up getting $4 or $5 million in a lump sum payment, and then depending on how it's treated, right? If it's an asset sale, you could be paying a portion of that as ordinary income, and then depending on what state you're in, that could be 40 or 50% at the worst case. So we really need to think about this now, and this is why, again, going back to those pre-sale strategies, if gifting or granting is an option, and especially if gifting is an option, right? The December 31st, 2025 will sunset this very large 12 plus million per individual estate tax exemption, lifetime estate tax exemption. So you can really do a lot of gifting right now for the next 3 years or so that you may not be able to do after then. So all of this really plays in, regardless of whether or not you're ready to sell the business now or 5 years from now. It behooves you to start thinking about these things. All right. So one of the things that we have seen that can work, that works for all parties, is kind of a combination, right? So say that you're selling the business, let's say, to your employees. They don't want to lose your knowledge. They also want to be able to get some benefit. And so paying you as a consultant and then the rest on a seller's note could be something that works, right? Now, the consultant income gets paid is going to be taxed at ordinary income rates. But if you're not the owner anymore, maybe you're in a lower tax bracket. Maybe that works out really well. The seller financing could be at the lower capital gains rates. So that could also work out very well. So we need to think about these things from the seller's perspective. And then on the flip side, we need to think from a buyer's perspective. Well, geez, if they're paying you as a consultant, that's deductible. Interest on seller financing, that's deductible. That reduces taxes. So all of these can be methods that can be really effective and much cheaper than going to a bank and taking out a loan. So I hit on this one last time, net value, right? And whenever we do a cash flow analysis for an owner that's thinking about selling, we want to be looking at the net value. You know, if your business is worth $5 million, that's great, but that's not what you're walking away with. And so we need to consider the options for getting you as much of that $5 million as possible. All right, while making the business sustainable and while not just walking away from the company and making a lot of people upset. And so, again, because this is not talked about as much, the worker ownership angle, just wanted to give a kind of a high level overview. So if for the last 3 years, you've been a C corporation or an S corporation or an LLC that's taxed, so remember, LLCs can choose how they're taxed. And then people do this for various reasons, but there's a potential that there can be some huge tax advantageous situations while you get paid fair market value. And so let's go back to the C corporation. The worst thing you can do in a C corporation is get double taxed, right? That's not what you want. We can deal with it if you have to. But one of the benefits of a C corporation is if you sell greater than 30% to an ESOP or a cooperative in the first year of the transition. So let's go back and use that $5 million. $5 million. If you sell at least 30%, 1.5 million, you can take that money and roll it into what are called qualified replacement properties, so stocks or bonds of U.S. corporations, and you can defer taxes indefinitely on that sale. And then as you sell more, you take that and roll it over. And you can continue to defer taxes. And if you come from a situation where there's a lot of wealth, you could defer taxes until you die, and then those securities get a step up in basis. So your family could inherit the proceeds from you selling the business essentially tax-free. I mean, that's a pretty powerful tool to use. And in specifically, one of the very interesting things about the S corporation structure is if you sell to an ESOP, you sell the stock of your company to an employee stock ownership plan. If you're a C corporation and you've been a C corporation for as long as you can prove, you can change to that S corporation election almost immediately, and you don't pay taxes. The business doesn't pay taxes on its net income. And the reason that this works is because an employee stock ownership plan is a retirement plan. And an S corporation doesn't have any corporate level taxes. Everything passes through and is taxed at the individual level. So if I own shares of a company through a retirement plan, it's the same as the money in your 401k. The gains on it are deferred until the money comes out. And so this is potentially huge, because even if you're an S corporation and you don't want to go through the hassle of converting to a C and then waiting 5 years to convert back to an S, you can make that direct sale to an ESOP. Yes, the owner is going to pay some taxes, right? They'll probably pay capital gains taxes on the transfer, but now you've got a business that's not paying taxes on its net income. Well, that's a lot more money that is left over to pay out a departing owner, so that you don't have to then go to a bank to get a note. So some really cool stuff you can do here that I just want to draw your attention to. It's not the right solution for everybody, but it's certainly one that we look at for all companies, including LLCs, because it's very easy to move an LLC into a C Corp if we need to. So all of this tax really leads into the estate planning, which all of you are probably familiar with these documents. Anybody who has any involvement with the ownership of the business needs to have updated personal estate documents, wills, revocable trusts, powers of attorney, medical directives, all of these things. And it's going to vary state by state, but it's important to get this stuff in place, because if something does happen, legal documents are never important until they are, and then they're super important. So, buy-sell agreements. If you've got multiple people who are owners in the business, you need a good buy-sell agreement, sometimes called a shareholder agreement. All right. Business and personal letters. I'll give you an example in just a second of what I mean there. And then how are you going to handle, is life insurance an important part of this? And we'll talk about that as well. So we've unfortunately run into this situation in the past where an owner has a tragic accident, ends up in a coma, right? And payrolls due. But nobody but the owner is able to do approval so that the bank can release money. Now, the bank wants to see stuff like a death certificate or an appointment of an executor or a conservator or something like that. Those are really, really hard things to do in a quick amount of time. And so just doing something like sitting down and writing a business letter, oftentimes called a professional will, where you lay out, okay, here is what will happen. Here is who is going to handle hiring and firing. Here are the people who I have given authority at the bank. Here are the people who can talk to these vendors and who will actually be able to make the business move forward. Those are critically important to make sure that the business is continuing sustainably. So really important to put this stuff together. Another one is payout, right? You want to make sure that if something happens to you, that your family is going to get paid. And we see this happen quite often with business partners, is that when they started the business, they took out life insurance policies on each other, which is a great idea to help buy out. But the business grows, which is awesome. But now those $500,000 life insurance policies don't do a whole lot for a $6 million business. And so this is where a buy-sell agreement, a really well thought out buy-sell agreement that addresses how life insurance can be used. Can it be used as a down payment with a note then signed to pay out the family? Can it be used as collateral at the bank? Now, these are really important because they will matter to your family and to the ability to take what you have built in the business and turn it into intergenerational wealth for your family. So critically important things to back up any good tax and transition strategy is making sure that these legal, both personal and professional legal documents are in place. So we're here to help. We're here to help anybody with any questions that they have. Feel free. We'll send out these slides, book a complimentary consultation with us, download this succession planning packet, use it, right? Just to start to think about this, because it's not something you're going to do all the time. It is key to start thinking about this as early as possible. And even if we just run some initial valuation and cash flow scenarios, just so that you have it in your head, can really help as you start to think about making some more of these strategic decisions. So with that, I know we've gone a little bit over the 30 minutes here, but a lot of stuff to cover. So Rick, we'll open it up to any questions.
All right. Well, thanks, Sam. That was great. We got some really good comments. One, thank you for this information. We're a family-owned company and are beginning to look at this process, so this was extremely helpful. Our big question is, how long before we plan to transition should we begin the process?
Yeah, so good question. And I would say 3 to 5 years, I think is you don't need to necessarily put everything in place at that time, but just beginning the conversation, even getting an initial valuation to figure out where you stand. Then we can start thinking about, how does this work from a cash flow perspective? What are the options available to you and your family? Who might be potential buyers? All those things. We can start that discussion, and it's a lot easier to do if we have time than, oh my goodness, the owner had a heart attack. Uh-oh, now we're really scrambling, right? We can do a lot more with that time horizon than, geez, we gotta make this happen because we don't know how long the owner is going to be able to survive.
Right. Okay. Now you said you'd be willing to share your PowerPoint slides.
Yes.
Okay. If you want to just email them to me after this, we'll send them out with the link to the recording to everyone who registered.
Awesome. Yeah. Happy to do that.
Perfect. That'd be great. Okay. We have some more questions here. What are you seeing as the annual administrative cost to administer an ESOP?
Yeah. Excellent question. So because an ESOP is a retirement plan, there needs to be an annual valuation so that everybody knows what their shares are worth. And it particularly becomes important when you have people leaving or entering the company, right? What are they buying at? What are they taking their shares away at? So typically that's anywhere from 15 to 25,000, depending on the size of the company and the number of employees, to do that annual administrative cost. But it is much better than trying to skimp on it and then ending up with an IRS audit or something. Because the problem with the downside, right, with any retirement plan is it's not only IRS, it's also the Department of Labor. So there's just more regulation around it. So we need to make sure it's tied up.
Got it. Okay, we have a kind of a two-part question here. What type of information is needed to do an evaluation, and what's the cost and time frame for an evaluation?
Yeah, so business valuation, what we do is we provide two documents. When we initially engage with folks, what we do is we'll provide them a pre-engagement request so we can ask certain questions like what type of entity are you, and has a business been valued before? How many owners do you have? Can you provide some high-level financials that then allows us to see what the business looks like and put together a proposal. And then once that proposal is accepted, what we do is we send a more detailed list of depreciation schedules and asset lists and all your P&Ls for 5 years and tax returns and all of that. And typically what we do is we'll charge all valuations, are a flat fee that we do. And it depends what it's for. I will say that valuations for planning, this type of planning work, are cheaper than valuations for gift and estate tax, because if I'm going to gift some money part of my business to you, Rick, not only do we have to come up with a value, but we also have to write a report that gets filed with a gift tax return with the IRS. So those require more work. So we're probably talking valuations, anywhere from 5,000 to 15,000, depending on the size of the business. But if it's gift or estate, there's going to be that charge for the valuation, and then there's probably going to be another, flat fee, 5 to let's say 10,000 for the actual report, because that's the report that the IRS will look at. And what we want to do is make sure that it's all as clear as possible so that there are no issues. Nobody wants to get their gift tax return challenged or their estate tax return challenged. So we really have to be more careful on those just because of the scrutiny.
So probably it sounds, these are very nuanced questions and the answers are really situational. So it's probably good for people, you encourage people to reach out to you. Okay, you have your contact information there on the screen. So yeah, so please reach out to Sam. He clearly knows his stuff. He does want to help. He's a good guy. And these are big questions, and there's a lot of money at stake. So we want to do the right things.
No, you're exactly right. And we are happy to work with anybody. And so we'll take a look at, things like size of business and what the strategy is and what the purpose of the valuation is. And we'll make sure that it works, right? We're not going to drive anybody into the ground just so that we can collect a couple thousand more dollars. That's not our goal at the end of the day.
So we have a question here. I could see some of my employees being interested in employee ownership, but there are some that definitely would not. Would an ESOP still work for us?
Yeah, good. That's an excellent question. So the nice thing about employee ownership is that you don't necessarily have to have every single employee involved in the ownership. With an ESOP, because it's a retirement-based plan, it's just like your 401k, right? There have to be some parameters, like 2 years, right? You have to be with the company for 2 years, and then you can participate in the plan, and typically you need at least 70% of the workforce involved in an ESOP, just like with a retirement plan, right? You can't just make a retirement plan that only Rick and I can be involved in, and the rest of the employees, they don't get an opportunity. So you do have to be more fair when you're setting up the ESOP structure, but you don't necessarily need to have everybody involved. And it's the same way if you decided for the worker-owned cooperative, there you can be even more specific and say, okay, you need to work for the business for 5 years. You need to have no negative performance reviews, and it requires a 70% vote of the current members to admit a new member. And so again, you can structure it so that you don't have to let everybody in. And it's perfectly fine if somebody's eligible and they say, no, thanks. That's all right. You've given them the opportunity.
Got it. Okay, we have one last question. I believe we set up a buy-sell agreement, but I haven't reviewed it for years. What are some important considerations for strengthening this document?
Yeah, so it's a great question. And we often find that one of the things we do with evaluation is we do review, especially if there are partners, that those partnership agreements and buy-sell agreements. So most buy-sell agreements are going to cover death. But it's really key that they cover other things like disability. If I, like the example we gave, if the owner ends up in a coma and is out of the office for 6 or 8 months, does that trigger a sale of those ownership shares? That's something that needs to be discussed internally, because disability means different things to different people. But if it's defined well, there's a lot less room for argument. Divorce can be a big one. Right? We don't like to think about it, but it happens more often than we'd like to think. And the last thing we want is a spouse gaining voting control in a company who is also disgruntled against one of the other owners. And so lots of times in that case, you can set something up to, if a divorce happens, the shares automatically convert to non-voting shares. And then the corporation has the right to buy out those non-voting shares. And so there are ways that these can be structured. But even things like retirement of an owner, that can be really, really important to stipulate their termination. You hate to think of it, but we've seen people terminated, owners terminated for cause, and that can cause some issues if there's not a clearly delineated process. The other thing that I would say and encourage folks to reach out to discuss more is from the valuation piece. It's just really important to be really specific. What is the valuation date? Are there discounts allowed? We're valuing equity, not enterprise value. All these things are important to delineate, because again, we're just trying to avoid emotional conversations, because when these trigger events happen, it tends to be around things like death or disability or divorce. That's a really bad time to be discussing, well, gee, should we value the business as of December 31st or as of June 30th? Well, depending on who you are, that could be a material difference. So we're just trying to avoid some of the painful arguments that can arise.
Got it. All right. Well, Sam, this was great. Very helpful. Thank you so much. If you have more questions for Sam, reach out to him at his contact info on the screen. Or you can, if you haven't registered yet for LBM Strategies Conference in Denver, I know we're actually close to selling out for the first time ever. So, but there are still some spots open. So go to lbmstrategies.com and you can check that out. And otherwise, that's it. Thank you, everybody, for joining us. Thanks, Sam, for bringing this information. It's really important.
My pleasure. Yeah, no, my pleasure. And look forward to seeing you, Rick, and the team, and hopefully a number of folks listening in next month in Denver.
That sounds great. All right. Have a good day, everybody.
Yep. Take care.
Goodbye.